Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about the government spending bill, Google's purchase of Sunday NFL ticket, and answer the question, will tech stocks ever rally? But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. Secure Act 2.0 is included in the $1.7 billion spending package. It passed the Senate yesterday and is in front of the House of Representatives today. Do you think it will pass?
Well, good morning, Allison. Good morning, everybody. And I should say that, happy holidays, Merry Christmas. We have that coming up this weekend. So hopefully you're taking a break from a lot of the stuff we're talking about today. Kind of hoping the views on this video are down, actually, because people hopefully are transitioning into some family time and some well-deserved time off. But before I get into the actual question here, I should say that the word of the day is down, right? I mean, a lot of folks, now that you're maybe easing off of the work schedule, got a ton of questions rolled in yesterday. So I'm starting to think people are maybe checking in on their finances for the year. And yeah, no matter how you slice it, unless you were in private equity only, you're going to be down, or CDs only, which nobody really was at the beginning of the year. You're down on the year. So that being down financially can get you down emotionally. So one of the things about investing, it's a long-term game. So you need to have a long-term focus, because otherwise you can get really depressed in the short term. So don't get down emotionally because we had an off year. You will have another off year. This will probably not be the worst year of your life investing. There's going to be more, but the up years make up for that. And then the last down, not only is your portfolio down, your emotions are down, the temperatures are down. We're in Texas, so obviously if you live north of us, you're probably not going to understand Texans complaining about the weather. But yeah, it's freezing out there, well below freezing out there. Kind of curious to see how we have a pool for the first time in several decades, and the first time we've had it actually freeze. So kind of curious to see how that's going to play out. But to answer your question, Allison, this is a huge spending bill, and it's a big political football. And I know everyone, if you say the 1.7 trillion spending bill or funding bill, the people that are tuned into these things have an immediate reaction of, OMG, this is exactly what we need. We can't afford not to do it, to the OMG. I can't believe we're spending another 1.7 trillion, after all these trillions do add up. Here's the message I have for you through the lens of financial planning and investing. First of all, Secure Act 2.0, like we talked about earlier this week, is buried in this thing. It is not contentious at all. So if they were to start redlining things out, it's a no-brainer to pass this thing. Of importance to you, that takes the required minimum distribution age from 72, kicks it out to 75. There's a lot of other stuff in there, some catch-up contributions. We talked about that. So we'll once it passes, we'll come back and do a Secure Act 2.0 only seminar. So that's number one. The second is a little more of a thought piece on interest rates. Now, we know inflation's the problem. Raising interest rates is supposedly the cure. And we've already raised interest rates, 25, 50, 75, 75, 75, 75, and now back to 50, where we're projected to at least do 25, maybe pause, maybe 50, 25, pause. I don't know. We're getting towards the end of this. Now that interest rates are up, to over 4%, almost 5%, there's a real problem with the national debt. And you're like, chuckle, Steve, there's always been a problem with the national debt. And it's like, well, okay, the size of the debt aside, just focus in on the math of how much interest we're paying. And when interest rates are higher, that means we're paying more just to cover the interest payment. So I really don't think interest rates can stay up here. I think this is a temporary thing, and I have this discussion every day. If you're locking into a CD at anything above about 3.5%, you maybe, if it goes higher, your CD drops in. I don't care about any of that. Roll out 2 years, and I think interest rates are going to be back down to close to zero, to be honest. Once interest rates start falling, or we start driving them down, they go to zero. I mean, I just don't see anybody going, you know what, 2%, that's good enough. We haven't done that. I think when there's no amount of adulting when it comes to interest rates, it's either like foot on the gas or nothing, right? All or nothing on these stupid interest rates, instead of just picking something and holding it in between. Because if we did that, a lot of people would be out of jobs, right? So anyhow, so my point is I think even if you're against the spending bill, I do think that it's going to continue to add to the problem of the national debt, which will eventually drive interest rates back lower, which again is good for investing. That's been the headwind you saw all year this year. So kind of wrapping up there, Secure Act 2.0 likely to get passed. We'll talk in more about that next week. And I think this will be another reason why interest rates will have trouble staying at the level they're at right now.
Next, Google parent Alphabet purchased the rights to sell NFL Sunday Ticket. Will this finally help ticker GOOG?
Well, I'm a big fan of the NFL, and I'm a Google subscriber. I don't do the YouTube TV, but I do the whatever the Google terabyte or whatever, how much memory you get to have and all that. So, and I like all the Google Docs and all. I like the functionality of Google, and of course, I like it as a stock. Right? There's multiple ways to win with Google, so we have that as one of our top 10 holdings here at Ankerstar Wealth, and personally, of course. So big fan of this, and I'm also a big fan of the NFL, so I like it personally. Is it going to pay off? That I don't know. It's a 7-year deal. $2 billion a year. Those are big numbers to have to recover. If they package it in with YouTube TV, which is, I don't use YouTube TV. One of my best friends does, swears by it, loves it. I don't have it. And, 65 a month. I'm like, I don't know. He says it's a good value prop, and I trust his judgment. We still are kind of old school, if you will, have the cable and everything. So, we'll see if they sell it separate, obviously from the prescription, which they probably will. They'll need so many additional subscribers to be able to recoup the cost every year. So does it make money? I don't know. Is it a value add? I don't know. But I do, I like the marriage, if you will. When you look at the Google stock, yep, house of pain, just like anything else in the tech world. These are the Class C shares. Remember, they have two types, A and C. GOOG is the Alphabet Class C. Tack on the L at the end, that's the Class A share. I mean, 1 year down almost 40%. Stock's been hammered. It was lower back in November. I've said we're not going to revisit these lows. But the Santa Claus rally, I mean, he needs to show up here soon because the market's closed this weekend, Santa. So if you're going to rally, it would be today. I just kind of don't see it happening. Too negative in the air. Too much negativity in the air. But no dividends. You don't get anything while you wait. Down 40% this year. But look at this valuation. I mean, come on, man. So cheap. Very profitable. $5 a share, PE sitting at 17. I think there's too many things to like with Google stock. So overall, excited about the NFL ticket purchase. We'll see. We'll see what happens long term with the stock.
Last, tech has been a complete disaster this year. Will tech stocks ever rally?
Yeah, complete disaster is almost being polite for some of the other descriptions I've heard from clients this year, right? I mean, it's really been a house of pain. When, if you're familiar with the term beta measures sensitivity to the market. Tech is always high beta, if you will, meaning when the market goes up, tech goes up more. When the market goes down, it goes down more. So, our bear market strategy at the beginning of the year was clean out all the speculative stuff and only hold best of breed with strong balance sheets, flight to quality, if you will, and you hold that through, which can be painful because you can see big numbers get smaller when you're talking 40% sell-off. But there's two names that came out this morning. This was published yesterday. Both of these names, one new, one old, are in the Ankerstar Wealth book. ServiceNow is a new name that we've started putting into the models, a week or two ago. Absolutely best of breed enterprise software player, and marries nicely with Salesforce, which has been in our aggressive portfolio for some time now. Again, ticker CRM and ticker NOW. So overall, I think this is it's good to hear. It's good to find an article that supports one of your major theses out there, but both of them been hit pretty hard. I think they have a lot of upside overall for tech shares. This is Tom Lee, who's notoriously optimistic, continuously optimistic, if you will, But just realize it's not really a matter of will tech go up, it's when. Okay, so process that for a second. So we know when the market flips, tech being higher beta, that when the market is going higher, which it does 2/3 of the time, that tech is going to outperform the rest of the market. It always has, it always will. Maybe always is a tough word to use, but you know, likely, high probability, if you will, because these are change the world type companies, and software companies especially. Does you develop the software, and then all of the revenue is license revenue, right? Um, so Tom Lee says, there's a chance that the Fed pauses hiking for all of 2023. I don't know about that. I think we see at least another 25 basis points in January. They forecasted that, so why not follow through? But certainly if they pause after that January meeting, then I think you will see the massive stock rally. It'll be the stock rally like we had coming out of COVID. The pain is over when the rate hikes stop. We don't need them to go back down all the way to zero. That will accelerate things, obviously. But if they just stop raising rates, that way it takes an unknown into the known category, and you can place your investments based off of a known high, right? So money's more expensive. Obviously, that's going to slow things down. As soon as they pause, though, I do think we do see a rally. We don't know when, but it's going to be a rally you don't want to miss out on. So I think don't bail on your tech now. If anything, now is what you'd want to be loading up on more shares while they're out of favor. Buy low, that sort of thing, so that when they scream higher, you take advantage of all of that return.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here on Monday.